Welcome everyone to our yet new video in our YouTube channel. So today we'll be discussing something very interesting where you can enhance your finance and the stock market journey and ensure you reach your financial goal much faster. Ganesh Komma. I'm India's leading finance and stock market coach, having an experience of more than 15 plus years in the Indian stock market. Right? So today, whatever we are going to deep dive on the discussion, we will discuss more on the theoretical part, and I am a great follower of combining theory with practical implementation. Right? So in this session, we discuss a lot of case studies using some stocks, using some sectors as an example. So do not consider them as a recommendation. Rather, use this as a case study, right? Because this helps you to understand the theoretical concept with the practical example, and the same example you can apply it in majority of the sectors, majority of the stocks which are exhibiting the same characteristics, right? So let's go and deep dive into this particular topic. Today, in our discussion, what we will learn is the power of diversification, right? The power of diversification. So one misconcept or one misnomer regarding diversification is having too many stocks is diversification for many people. No, that's wrong. When you invest in too many companies, which is crossing a certain limit, then you will not be able to track those companies. And as you add more and more companies, if there are more losers, or if there are companies which are losing out or which are giving you negative returns, that will impact your overall portfolio's health, right? That will impact your overall portfolio's health. So diversification is very important. And yes, if you are having too many stocks within a certain limit, your immediate actionable is yes. It's not that you close all the stocks or you exit the stocks at a single time, but you have to keep a target. Yes, in the next 1 month or in the next 3 months, I'll be cutting down my stocks by 10% or by 20%. And how do you cut down the stocks? You exit stocks which are weaker in nature, which means if the overall broader market is increasing, or if the overall broader market is bullish, but any stock in your portfolio which has been a laggard or which is stuck at a position for a very long period, or the stock is bleeding, or the stock is in losses for a very long period, that's the best time to clean the portfolio, right? To clean the portfolio. Having a very concentrated portfolio is important, right? Having a very concentrated portfolio is important, and anything which are too many stocks, not good. One, you cannot track, and any stock which is doing well, you should increase more in the number of positions, right? Which means you have to add more into that stock. Now, what we will do, let's learn about these diversification rules, right? Let's deep dive into what are the diversification rules, right? So we will be studying the basic rules, what we need to understand, and we will study for the long term related, and we will also study for the short term, right? Long term, anything you are holding for more than 1 year, right? Anything you are holding for more than 1 year, or even 3 years, or 5 years and above, right, comes under long term. And short term, less than 1 year, comes under short term, right? Less than 1 year comes under short term. And here, a portfolio should always be bifurcated into two parts, right? So you can have short term 40% of your portfolio, and long term you should be having 60% of the portfolio, which means normally an ideal investor or a smart investor will always have his portfolio into two parts. One, our main focus, right? Our main focus is for long-term wealth creation, right? Companies which you hold for a longer term and the money compounds, that is where wealth is created, right? That is why majority of our holding will be in long-term related stocks which are stable and consistent, right? And yes, certain members who are like conservative investors or beginner investors, you can have your long-term portfolio up to 70% and short-term portfolio 30%. So yes, sir, any stocks which I feel are good for short-term, like swing trading, right? I invest for a couple of weeks, I invest for a couple of months, you can have it in the short term, 30%. And long term, that is where my wealth is created. And in short term, whatever profits you make, it's not that you immediately book and you spend it or you use it as an expense, right? Whatever profit you make in short term, you can move it into your long term stocks so that your wealth is accumulated and generated, right? And generated. So now let's move into the first rule, which are the rules in diversification. The first important thing is an ideal portfolio should be between 20 to 25 stocks. There are many investors who have 40, who have 60, who have 80, and even some people more than 100 stocks, right? No. Any portfolio where you have more than 25 or max more than 30 stocks, the purpose of diversification itself is lost, right? The purpose of diversification itself is lost, right? And these stocks should be a combination of both short-term and long-term stocks. Yes, sir, we have divided the portfolio into two parts, long-term and short-term, long-term 60, short-term 40, or long-term 70, short-term 30. So both the stocks combining together should be between 20 to 25 stocks. That is an ideal portfolio, right? That is an ideal portfolio. And to get the benefits of diversification, that's how you need to do it, right? That's how you need to do it. Because if you have a particular set of stocks in your portfolio, you'll be able to track, right? So how you can do, you can diversify in sectors. Yes, sir, I have maybe from electrical wire products, I have some 3-4 companies, right? Maybe like Polycab India, KA Industries, right? Havels India, so Finolex Cables, something like that. I have diversified into some sector, right? Defense related, I have Cochin Shipyard, I have Mazagon Dock, I have GRSC, right? Like that. In PSU banks, I have some companies, right? Like Indian Bank, your Bank of Maharashtra, Canara Bank, some stocks in the PSU banking, right? Some stocks into the railways, RVNL, ERCON, IRFC, right? So like that, you can diversify between some happening sectors, some stocks. But anyone who are in the process of, sir, I think this is a happening sector or this is a good stock, so I'll just enter in 5 stocks. I'll just enter into 10 stocks and then I move to another company, right? So if you accumulate too many companies, the diversification purpose is lost, right? Ideally is between 20 to 25 and the golden number is 23 stocks, right? 23 stocks. And lastly, having too many stocks just for the sake of diversification, one, the purpose is lost and it will be very difficult to track, right? So in one of our recent discussion, when I have asked how many number of stocks you have, one person came and told me, sir, I have 118 stocks in my portfolio. My immediate question is, how are you able to track? Or do you remember the name of the companies you have in your portfolio, right? So think about it. Just for the sake of diversification, do not add too many companies. What you need to do, any stocks in your portfolio, where when the overall market is increasing, that stock is declining, it is in a bearish mode, or that stock is not moving anywhere, or that sector is itself not moving from a very long period, or you are not comfortable in that position, exit that position. And when the markets are high, that is the best time to clean your portfolio, because the overall market is trending, but in the portfolio wise it's not moving, then there is a problem. And when there is a market weakness, these stocks will further decline, right? So it's not that immediately you exit all the stocks. Keep a focus, keep a deadline, keep a target. Yes, in the next 1 month or in the next 3 months or in the next 3 months, I'll be cleaning 20 to 25% of my portfolio. And in the next 6 months, right? In the next 6 months, clean by another 20%, another 25%. So gradually, you have to make your portfolio more concentrated, right? More concentrated. Now, let's look at long-term stocks. Sir, what kind of a sectors or what kind of a category comes into long-term? Any company which is stable. You see the profit growth for 1 year, 3 years, 5 years, where you see a double-digit growth in the profits. You see a double-digit growth in sales for the last 1 year, 3 years, 5 years, or even 10 years. You see a double-digit growth. ROE, return on equity, is moving at a decent levels, right? And the sector is good, and the company, there is a long-term perspective for it, right? Those kind of a companies we keep into long-term, right? Long-term, and we use Screener as a platform to analyze these companies, right? We can build a screen to identify companies where the sales, the revenue, the return on equity for the last 3 years, 5 years, where it is increasing by more than 10%, where it is increasing by more than 12% year on year. So out of the thousands of companies in the universe of stocks, you can shortlist those 20-25 companies. So if you are loving till now, right? If you have been loving this discussion till now, and if you feel that it is adding a great value in your learning, I want you to click on the like button. I want you to subscribe to my channel and hit on the bell icon so that any future sessions, any future learnings, you will be notified much in advance, right? Much in advance. And I want you to take your key learnings till now in the comment section below, right? In the comment section below, because my sessions, I do not want you to just take the inputs. It's not be a one-way kind of a discussion. Rather, I want you to participate, right? I want you to participate, and whatever is the key learning, whatever are the stocks you are following, or whatever are the stocks you feel that they are good to enter now, based on the learnings we had till now, you can mention in the comments below, and don't forget to click on the like button for this particular video and do subscribe for this channel from using Screener platform, right? And long term should be a mixture of sectors, right? Should be a mixture. There are few people, sir, I have IT companies, long term companies, maybe like a TCS, HCL Technologies, right? Birla Soft, so Persistent Systems, all these long term large cap stocks. I have 50% of my portfolio only into IT sector, right? So you do not know what will hit the sector, which news can hit the sector, and if that is impacting, your entire portfolio will bleed because you have concentrated 50% of it in only one sector, right? In only one sector. So you should have a mixture of sectors, like as I have discussed couple of minutes before, like defense, railways, PSU banks, automobiles, your electrical wire products, or pharma, right? Diversify into 3-4 sectors, right? And you can have like 10 to 15 stocks in your long-term portfolio, and each position not more than 4%, right? Each position not more than 4%, so that you are not over sizing the portfolio, right? You are not oversizing the portfolio, right? So any company where you have invested and where you are tracking and you are able to increase more in the percentage will give you a better return, right? Will give you a better return. Until and unless there is a company where you see a huge growth, right? There you need to add more, right? There you need to add more, right? Now let's look at short term, right? Let's look at short term. Sir, now how do I assess the short term stocks, right? Short term stocks, We don't go for 3 years, 5 years, 10 years data of sales growth, profit growth, or ROE, right? These are turnaround companies, right? These are turnaround. For example, in the last 1 month or in the last 2 months, we have seen a great traction happening in railways or even defense, right? Couple of quarters before, right? Couple of quarters before, if there is a news in fertilizer space, if there is some special scheme which the government has announced, or there is some rebates which government has announced, maybe like fertilizer space or cement space, right? If there is any news, if there is some momentum happening, maybe just to accumulate that profits, we'll be entering into short-term stocks, right? So short-term, we don't look at high quality of the company, but yes, technically, if that sector is in momentum, right? If that sector is giving good profits, right? Majority of the stocks in that sector is giving profit, right? Then we look at a short-term related thing. We don't look at more quality, but we look at the price and the volume for short-term stocks. And our intent is to hold for less than 1 year. Here there is one very important point, right? Whoever are looking at taxation angle, sir, yes, I've entered into a stock. If I'm selling it less than 1 year, short-term capital gains is 15%. But if I'm selling that stock more than 1 year, long-term capital gain is only 10%. So I'm saving on that 5%. So I'll wait for that stock to cross 1 year and then I will sell. My answer to you is, don't exit a stock based on the taxation part. No. Exit a stock based on its strength. I'll give you a simple example, right? Let's say you have purchased a stock called as A Private Limited, right? In, let's say, January you have purchased, right? At 100 rupees. Okay. So by July or by August, the stock has moved to 125 rupees, right? So you have had a 25% profit, right? You have had a 25% profit. And yes, by October or by November, the stock has moved to 130 rupees, right? 130 rupees. And if you feel, yes, it is being stuck at around 130 rupees for a very, very long period, it's almost like a 30% profit, right? It's almost like a 30% profit, and you do not see a further growth in that profit, right? Or if it is stuck at the same level for a very long period, whoever thinks, yes, if I sell the stock now, I have to pay 15%, which is my short-term capital gains. So I will wait till December. I'll wait till December, and after December I will sell so that it is completing 1 year. So instead of 15%, I pay only 10% as a long-term capital gain. What if in this 1 month, if the stock comes back to 100 rupees, or if the stock may even fall down to 80 rupees or 90 rupees, right? So don't just wait for the stock to cross 1 year for the taxation part. Rather, look at the price and the volume strength and exit, right? Even if you pay 15% on the profits what you make, this is a very good deal, right? Very good deal. So don't wait for the taxation part to complete for the 1 year related, right? And short term, yes, out of the portfolio, maximum 30% or maximum 40%, right? And short term also have diversified into sectors, right? X sectors don't have maximum exposure. And in short term, yes, around 10 stocks you can enter and initiate with a 0.5 to 1% of the overall portfolio. Now, one of the important question, sir, you said short term, we need not look at quality of the stock, right? We just look at the price and the volume, right? We look at price and volume strength, not the quality of the company. Sir, what if the stock goes bad after I'm investing? Always remember, whenever you are investing, enter in tranches. What do you mean by tranches? Enter in parts, right? Tranches means parts. You do not do lump sum. So if you have identified one stock, let's say, sir, I have identified JBM Auto from the automobile industry. I think JBM Auto is giving some good strength, and the automobile companies are also doing well. So what do you do when you are entering your first tranche, which means your first position, enter with 0.5% of your overall portfolio. Sir, my entire stocks, I am holding around 10 lakhs. My entire portfolio is 10 lakhs, right? So 0.5% or 1% of your overall portfolio should be your first investment, right? So on 10 lakhs, 1% is 10,000 rupees, right? So your first tranche will be 10,000 or even 5,000 rupees. And as the stock moves in your direction, you will add your next tranche, second tranche, another 1% or 2% of your overall portfolio you will add. So what is the benefit of it, right? What is the benefit of it? One, if the stock is moving in your direction, you always have the opportunity to add more into that stock. When the stock is going down or it is going in loss, you can exit that stock with a small position. You have just entered 1%. Yes, you can exit the stock with a strict stop loss, right? From the purchase price. The stock is declining more than 8% or more than 6%, you exit. And when you're exiting also, as you have had a small exposure or small position, you don't incur huge loss, right? For short-term positions, always enter with a smaller position and gradually increase it, right? Gradually increase it. So these important diversification rules, if you follow, your investment journey will be very smooth, right? Investment journey will be very smooth, right? Some of the key pointers in this diversification rules are: one, always have your portfolio into long term and short term. Do not skew majority of the stocks into short term or majority of the stocks into long term. Second point, have a concentrated portfolio where you will be able to track, where you will be able to look at the companies, and wherever there are strengths, you can accumulate more into the stock. And whenever you're adding, add in tranches, no lump sum investments, right? No lump sum investments. And instead of accumulating into one specific sector, majority of the portfolio, diversify, right? Diversify. Because if right now defense is doing good, maybe PSU banks would be flat. After 2 months, maybe defense would be flat. PSU banking stocks will flourish, right? So if you have a mixture of sectors, at any point of time, your portfolio will be moving ahead, right? So have a diversification within the sectors also, 3-4 sectors you can diversify. And the last point, if you have too many stocks, analyze the market. The market is bullish, the market is doing well. The stocks which are not moving anywhere in your portfolio, or the stocks which are continuously bleeding, or the stocks which you are not comfortable, reduce gradually and make it a more concentrated portfolio rather than a zoo in your portfolio. Okay, so I hope everyone loved this discussion. If you feel this is very important right now, type it as love in the comments below, right? Type it as love below. Follow for more financial insights. Hit on the like button, subscribe to the channel, and don't forget to click on the bell icon so that all the future notifications you will be getting much in advance, right? Be a lifelong learner and be ready to learn, so that helps you to compounding your wealth.